there are a few very interesting developments around Bitcoin in the last few weeks. And in this video, we're going to talk about a few charts taken from the weekly Glassnode newsletter. So Glassnode brings out a newsletter every single week, and I'll give my 2 cents of what I think about this data. So let's first start off with what actually happened in June of this year. This was one of the very worst months that we have ever seen in Bitcoin. We haven't seen that bad of a performance since 2011, when Bitcoin was just at around 10 US dollars. The reason why I find this interesting is because the general narrative is that volatility around Bitcoin tends to decline with increasing market cap, right? Since Bitcoin is now several billion worth of capital, it's expected that it grows slower, right? It takes more money to move Bitcoin. But that, on the other hand, should also mean that the downside risk isn't that pronounced anymore. We have actually seen, if we just measure from the different market cycle tops to the market cycle bottoms, we have seen a decline in severity of those crashes. But if you look at this just from a month-to-month basis, this development isn't that obvious. If we just look at it in terms of the performance within June, it was really, really bad. We rarely saw that much of a decline. If you're currently getting discouraged and if you don't feel like buying Bitcoin, I wouldn't blame you, right? These are exceptional times. Still, when we look at this from a long-term perspective, right? Since January of 2016, where we've got our first bull run, then the crash in 2018, and the subsequent bull run until beginning of last year, with the current crash, we can see that the number of active addresses, or a 7-day moving average of that, tends to increase over time. Right? So the adoption of Bitcoin tends to increase. The actual number is here on the left. So it starts at 400K, they're currently at around 800K. So the number of active addresses has approximately doubled in those 6 years. And what's positive around this is that the price, of course, in those 6 years went up way more than just 2x, right? So double the number of active addresses means more than double of a price increase. You can even see we are now pretty much at the same price level as during the hype phase, the end of 2017, right? The price is at 20K, but the active addresses, it went from 1.2 million to currently less than 900K. So we can see there's some kind of a resilience in price. We can even see a decline temporarily in number of active addresses while the price stays stable, or from another perspective, the number of active addresses tends to rise quicker than the price does, which in the end simply means that the people that get in contact with Bitcoin tend to stick around. People get intrigued by the short-term rallies at the beginning, but then become long-term holders as time moves on. There's a bit of an adjustment also that Glassnode is doing here. So this is just the raw active wallet addresses, right? Glassnode also cleans this up by clustering several wallets into active entities. So several wallets can belong to one entity. An entity is, for example, a company such as MicroStrategy or a whale that might own several wallets. So it simply does this clustering. And in here, the same effect is even more pronounced, right? The decline of those entities, it almost cut in half from the peak of 2018 to today. Less entities are active, but the price is the same. Meaning, if we just cancel out those boom and bust cycles over the long term, Bitcoin still tends to increase. Another way to look at this is to follow the number of transactions. So transactions, simply a measure of how much speculation we face in the market. When it's high, the price tends to be high. When it's low, the price tends to be somewhat depressed. It's not necessarily a good measure for figuring bottoms, right? The price here was still at 8K. We fell all the way down to 3.5K afterwards, even though we've already seen the bottom in activity. So it's not necessarily good for timing bottoms, but it's relatively good to spot heated activity when we can see a temporary price drop afterwards, right? Pretty high here in activity in July of 2017. Afterwards, we had quite a bit of a correction in price. Then, of course, the crypto winter, very high on activity. And we saw the 80% crash in Bitcoin. And each time we see elevated prices, we also tend to see elevated activity. That's when we potentially want to sell. Currently, of course, we are not at any kind of elevated level here. this goes without saying, we are not in a hype phase right now. Attention on crypto is low. It's so low that one might argue that we even see some kind of a capitulation phase now. So this is kind of a reflection of the risk aversion that we can see in the market. We see that the deposits to exchanges is obviously going down, right? Less people want to move their fiat into crypto to speculate on it because it's simply not that sexy to now buy Bitcoin or crypto in general. So this makes sense. What's also interesting though is there's not just general activity that's going down, that also withdrawals are going up. So people are actively taking money out of exchanges. And the reason for this is not necessarily, we will come to this later in the following charts, it's not necessarily that people don't want to hold Bitcoin or that the Bitcoin holdings themselves are declining among the smaller investors. It's rather that people get risk averse. As in, we have seen collapses of exchanges, we have seen the Terra Luna collapse, we have seen Celsius. And so I would not be surprised, I don't have those numbers, right? But I would not be surprised if the hardware wallet manufacturers are currently facing a boom. People don't trust a third party anymore. The saying, not your keys, not your crypto becomes trendy again. And this is, I think, what's reflected with this chart over here. You don't want to have your capital on the exchange. If the exchange goes bust, you're facing potential loss of your capital. And so with this development, we can now see that the balance on exchanges is on a further decline. Initially, of course, this was growing as the exchange business itself was growing. But we can even see since the Corona crash, even during this rally, the balance tended to decline. Now look at the left scale over here. This reaches from a bit over 3 million all the way to 1 million. We now, in those 2 years, roughly declined by 500,000 and we are at 2.5 million. So if this continues to decline in this way, then in 10 years, roughly, we would be at 0. Now, I'm not going to say that this will happen in 10 years, but simply the lower the balance, the tighter the order books are on those exchanges and the more the price can be moved with relatively little capital. So seeing this balance again lower and lower might actually introduce more volatility. It might also introduce more upwards pressure, right? In case we then see again a rise in activity and there aren't enough Bitcoin on the exchanges, this will put a lot of additional self-fueling rising price pressure on Bitcoin. Next, we've got the exchange net position change. So this is simply the first derivative of the prior chart. Most of the time, Bitcoin flows out of the exchanges, and when it flows in, it usually has a strong reason, either Luna collapsing or miners having to sell their Bitcoin because Bitcoin banned mining during that time. Right? So, but besides that, we don't really see that much inflows. The Bitcoin outflow chart, the Bitcoin outflow trend, the long-term trend seems to be relatively stable. And we can see this similar behavior when we look at the on-chain metric of illiquid supply chain. So this looks at how much Bitcoin is moving to wallets that never saw any kind of activity before, right? So this is unlikely to be exchange wallets. This is likely going to be hardware wallets or paper wallets, some kind of cold storage. And most of the time we see Bitcoin is just being accumulated, creating then these long-term floors for Bitcoin. And who's actually buying? Who creates this floor? It's the small guys. It's the wallets with a balance less than 1 Bitcoin. And this chart, I think, tells a very interesting story. At the beginning, in the bull run of 2017, a lot of small investors bought into Bitcoin and there was a lot of hype, right? So a lot of position change here. The small guys buy up and then they basically stop buying. Only for a very, very brief period of time, we saw actually a negative net position change of the small retail crowd. And we see a continued DCAing in, right? It looks like the small guys are buying up the Bitcoin. And then we see a peak here just after the Corona crash. So general retail got somewhat smart. They didn't buy up the hype anymore. They actually started buying the crashes and the dips. And this is then what made a lot of people a lot of money here, right? You bought Bitcoin for 7K and then you rode up this wave all the way to 60K, almost 70K. And then the question is, of course, did you take advantage of selling at least some of that highly priced Bitcoin? What I find fascinating is how the psychology now shifted, right? The shrimps, the small retail people, they really bought this dip very heavily. So the green line here is really high. The dollar cost averaging happened by the small guys. Those are the ones that are supporting the price. It's the big people that are selling off. It's the institutions that get somewhat spooked, but not so much the retail crowd. The orange line here is just the accumulation of this, right? So more and more people buy into Bitcoin, or at least the small wallets continue to buy. And then we see now this sharp rise, the transfer from large wallets to small wallets that happened during this crash. People are now taking advantage of the depressed prices. And the longer this obviously happens, the more decentralized Bitcoin will be, the more broadly it will be owned by a lot of people, and the more stable the price will become. Now, what I find interesting around this exchange movement, right? The centralized exchange movement is that Coinbase is really having a hard time and that Binance is about to flip Coinbase in terms of Bitcoin balance held. Now the Coinbase stock itself already went down, I think 75% or so since IPO. So it didn't do well by betting on Coinbase. The underlying metrics seem to support that. We are about to see the flippening where Binance overtakes Bitcoin. I'd not be surprised if this continues. Now the question is, can Binance also overcome some of the regulatory questions and can get into a similar territory of being a very safe exchange similar to Coinbase? That's not yet clear, but the adoption definitely speaks for Binance. More and more Bitcoin is held by the Binance exchange. Now this might be the most important of all of the charts, and this shows who's buying, who's selling. And this is very much in line with this shrimp net position change chart, as in small people are buying. This shows based on cohort, so based on how large the wallet is Bitcoin getting into the wallet or is it getting out of the wallet? If it's blue, then we've got accumulation. If it's red, it's selling. And we can see that since Bitcoin is at 30K, the small guys, they are buying heavily, continuously. And the very large wallets are also buying. Maybe those very large wallets are mainly exchange wallets. That's what I suspect. This might be cold storage of exchange wallets. So those two are buying. The middle is not buying so much. So whatever the next rally will be, it's unlikely going to be fueled by institutions. The reason why Bitcoin isn't already lower than it is today is because of small people buying in. And so we just have to give this more time. Small retail has always been the foundation of Bitcoin, and the current development seems to support a return to that narrative. I welcome that. I like that it will very likely lower the correlation between traditional finance and crypto again. I think Bitcoin is better held in the hands of many people rather than in the hands of a few whales that can manipulate the price. So I like this situation. In the past, we saw that there was retail that bought first and then institutions and larger wallets that came afterwards. So they basically followed the small guys that front run all of those. Hedge funds and family offices, we saw this twice in this chart, right? First it's retail, then it's the larger ones. Currently, retail is buying again heavily. The larger wallets are not yet following. Let's see if this happens. I personally wouldn't even care if it doesn't. It simply needs to take long enough of a time, and then the dollar cost averaging by the small guys will impact the price in a relatively solid way to push up Bitcoin again to new heights. Please give this video a like in case you enjoyed the content, and don't forget to subscribe. We've also got a public Telegram channel. Simply search for Bitcoin Strategy Channel within the Telegram app. Last but not least, there's a premium membership where you can ask me any questions. A lot of exclusive content there. More information is to be found at thebitcoinstrategy.com. The link is also in the video description. There's another video where I discuss the current state of the bear market, a relatively casual fireside chat. So hope to see you in that video, and thanks for watching this one. Bye bye.